Hi, my name is George Dagnino. I'm the editor of the Peter Dag portfolio. I just finished to listen to a very famous economist, well known and someone I respect and much smarter than I am. And he just laid down all the reasons why there is going to be a deep recession uh, with credit issues, uh, lack of everything. And then he quoted also a very famous economist who discussed in recent papers the end of the American empire. So I felt a little humbled by all this so smart people saying these things. But again, my concern is what is happening right now. And what I learned is that what is happening right now is what really drives the investment strategy. You have to act accordingly. So the purpose of this review of these charts is to show you what is happening now. What can we think is actionable from an investment viewpoint? The question, of course, is a recession or a period of poor economic growth. Why? Because if that is going to happen, the market is going to decline. And if history of any lesson, the decline could be anywhere between 25 and 50%. So we have to know what is the outlook? Are we at the edge of the precipice or not? So, but let me go back to what is my framework. My framework is the business cycle. Now, there are four phases. The crucial phase is phase four, this one. Why? Because phase four corrects all the issues that's been created during the period of expansion in phase one, the periods of expansion and rising in inflation and interest rates, the beginning of the slowdown, because it takes place because now consumers are the purchasing power in real terms is decreasing. So consumers are stopping or slowing down their purchases until when? Well, until the causes of their concern are being taken care of, which are inflation and interest rates. So they will cut spending until those parameters are corrected. Business, in the meantime, slows down because demand is slowing down, so profits are in danger. So what you see in phase four, which is what happens in the recession, you see the basic parameters of the economy: income, spending, uh, production, and employment. They come down. You see commodities coming down. You see interest rates coming down. When all these things have come down enough to encourage consumers to go out and buy again, what you see is phase one, and the economy expands. This is what we have to worry about. This is when the market declines anywhere between 25 and 50%. So what I like to do now is look at the data, just the data, and see what happens. I know all these smart people are talking crisis, and I sort of believe them, but I have to work myself out from here to there, which is could be in the next 5 months, it could be the next 2 or 3 years. So because the same people have been dead wrong in 22, 21, 22, 23, they always say this year is going to be a recession. It never happened. So yes, they will be right because they're so smart. But let's look at the data now. As I said, we have to start worrying when we see production, employment, spending, and income declining. This is when we start to worry. So let's look at these indicators now. This chart shows production and real retail sales. I'll show always the data after inflation. And what you see is that industrial production, which is the red line, has been picking up and is now close to it's around 1.5%. Retail sales after inflation is around almost 3%. So production and retail spending is strong. There are all sorts of reasons why this can happen, the tariffs and this and that. They always bring up all the excuses, right? No, the reasons why. But the data are the data. This is what's happening. So this is very positive. Let's look at now unemployment. Yes, employment, the headline numbers are growing. There are some cracks in employment. For instance, the temporary service are slowing down. Employment in trucking is declining. But the crucial figures of employment are employment in construction and residential buildings. Why? Because they see here they peak ahead of a recession. The recession is this blue, the shaded line. They peak months before recession. They peak before a recession. They peak before a recession. They peak, well, this was a particular case of COVID, but still they flatten out. Here what you see is production, the construction employment are still growing. They're slowing down a little bit, but it still are expanding. So the employment picture may be slowing down, but still is positive. Housing is a very important leading indicator of the economy for many reasons, from an employment viewpoint and because of the sensitivity to inflation and interest rates. This chart shows the housing start, which is the red line, okay, and the money supply M2, which is really the amount of liquidity in the system. The growth of the economy depends on that. But what you see is that the housing starts and the money supply always peak close to or ahead of the housing starts always peak ahead of a recession. Here they're still growing, they're still moving up. So what it's saying is, yes, interest rates are high, but they're still not dangerously higher. So people are still buying, there is still a transaction in the housing market. The time you have to worry when you have this precipitous decline like here, you see the break. Here there is no break in the housing market. Not only that, but you see the housing market strengthens when liquidity is improving. So you never see housing declining with liquidity rising. You always see housing market and liquidity declining, housing market declining and the money supply declining. So the housing market, which reflects a major sector of the economy, construction, is not booming, but it's not even contracting to the you showing a pattern seen ahead of recessions. The other important parameter among all the ones we saw economic data that we've shown is the credit market has cracks or there is a risk in the credit markets? Is there some distortions? And there is the one way to look at it is looking at the credit spreads between low grade bonds and high grade bonds. And as you can see, when there is a credit issue in the economy, like here, like in this ahead of 2020, you see that the credit spreads start rising. This means that there are some really issues in the financial markets. These are so sensitive, these credit issues, that our business cycle indicators picked up on these changes. And what that means, the economy is strengthening and then it slows down, is strengthening and then it slows down. This is what the similar pattern that you see in our uh, business cycle indicators. In other words, an increase in credit risk causes the economy, like here or like here or like here, the economy to slow down, of course, because people, the financial markets liquidity doesn't flow the way it's supposed to. Now, what's happening now? Well, the credit spreads are fairly well behaved. They don't show this ramp up in trend that you see in previous instances. So even the credit markets say, look, the employment is okay, income is okay, retail sales is okay, production is okay, the money supply, as I showed you before, is expanding, and there is no credit risk in the financial markets, meaning there is enough liquidity in the system. So the bottom line is, what is the implications for the stock market? Well, the economy is okay. It's growing at around 2.4%, 2.5%, which is slightly above the above average growth rate of the past several years. So the economy is growing. What about implication on the stock market? Well, this is the spreads that I showed you before, and this is the stock market, the S&P 500, and this are the spreads, the bond spreads. And as you can see, when the bond spreads rise, the market doesn't do much. When bond spreads rise, the market has a peak. When bond spreads rise, the market peaks. The bond spreads right now are still heading lower, and therefore here they declined, so the market is rebounding. So as far as the credit issues and liquidity issues over the intermediate to long term, things are still okay. Now, as I showed you, I have the discussions on the near term. I just sent to you the market update as of today, so you know what my ideas are in the very near term. But as far as the basic structure of the economy and the stock market, as of now, there is nothing really to worry about. For those of you who are not subscribers yet, I just would like to remind you that we have 3 levels of membership: videos like this one, membership number 2, videos and market updates every Sunday. And membership number 3 is the Peter Dack Portfolio, which is our research report, about 22 pages, videos, there are model portfolios, and of course, market updates. And all this you will find it in www.patreon.com/Peter Dack. If you want to find more information about our work, please go to our website, www.patreon.com/Peter Dack, and where we have all our research reports and all our publications.